Taxes. They're the one thing we can never really escape, no matter how old we get. And for seniors, it often feels like the system takes more than it gives. But 2025 has brought something new to the table, a promise of a 6,000 tax break designed specifically to ease the pressure on retirees. Sounds great, right? 2, the 48, but here's the thing, not everything that looks good in the headlines ends up good for your wallet. That's why today we're going to cut through the noise and look at what this benefit really means. Is it free money? Who actually qualifies? And most importantly, how can you use it to your advantage instead of letting it slip through your fingers? Because the truth is, a tax break is only as powerful as the strategy you use with it. And while 6,000 might not seem life-changing at first glance, when you use it the right way, it can have a serious impact on your financial security and your retirement future. What the 6,000 tax break actually is, when people hear 6,000 tax break, their first thought is usually, does that mean I'm getting a 6,000 check in the mail? And I hate to break it to you, that's not what this benefit is about. A tax break doesn't work like a stimulus check. It's not direct cash being handed out by the government. Instead, it reduces the amount of income the government can tax, which means you keep more of the money you already have. Let me explain it in simple terms. Imagine you earn 40,000 a year from Social Security, retirement accounts, or part-time work. Normally, the government looks at that 40,000 and says, okay, let's calculate your taxes. But with this new 2025 benefit, seniors are allowed to deduct up to 6,000 more from their taxable income. That means instead of being taxed on 40,000, you're only taxed on 34,000. And depending on your tax bracket, that could save you hundreds or even over $1,000. 8, it's important to understand that this benefit isn't a one-size-fits-all. The savings you see depend on your income level and how much you owe in taxes to begin with. For someone in a lower tax bracket, this break might mean a few $100s saved. For someone with more taxable income, it could mean significantly more. Either way, it's designed to put money back in your pocket, not the government's. Why 6,000? Now, you might be wondering, where did the 6,000 figure even come from? Lawmakers designed it as an additional standard deduction specifically for seniors. You see, the standard deduction is the baseline amount that everyone can deduct from their taxable income. But seniors, because of the higher costs of healthcare, retirement expenses, and inflation, are getting an extra cushion. That's what this new 6,000 is all about. It's not random, it's an acknowledgement that seniors face unique financial challenges. Why this matters right now, some people might shrug and think, so what? It's just a tax form change. But here's why it matters. For many retirees, every single dollar counts. Think about your monthly budget. If you save even $500 in taxes, thanks to this new break, that could mean an extra month of groceries, a new pair of hearing aids, or even the ability to take less money out of your retirement accounts. That's real impact. And in a time when inflation is making everyday essentials more expensive, even small tax changes can have a big effect on your quality of life. What it isn't, it's just as important to be clear about what this benefit isn't. It's not automatic cash in your bank account. It's not unlimited. You can't stack it infinitely. And it doesn't mean zero taxes. Some seniors might be disappointed if they misunderstand it and expect a huge payout. That's why education is key here. Another thing to note, it's not retroactive. That means you can't go back and apply it to previous years. It only applies moving forward, starting with your 2020-25 return. So if you don't understand how it works, or if you don't file correctly, you could miss out completely. The bottom line of what it is. So here's the truth. The 6,000 senior tax break is a deduction. That means it reduces the portion of your income that the government taxes. It doesn't magically create more money, but it helps you keep more of the money you've already earned. Think of it like plugging a leak in your financial bucket. Before, some of your money was draining away in taxes. Now, with this extra deduction, less drains out. That might not sound exciting compared to a big, flashy stimulus check, but over time it adds up. And when you combine it with smart financial decisions, like using that saved money to pay down debt, invest, or build an emergency fund, it becomes even more powerful. To sum it up, the 6,000 tax break isn't a lottery win, but it's a real, tangible advantage that seniors can use to improve their financial stability in 2025 and beyond. The people who take the time to understand it and apply it correctly will see the most benefit. Those who don't may completely miss out. That's why knowing the details matters. Because in the world of money, it's not the big flashy promises that change your life. It's the small, consistent wins that compound over time. And this tax break could be one of those wins. Who qualifies and who doesn't now that we've broken down what the 6,000 tax break actually is? The next logical question is who gets it? This is where things get tricky because not every senior automatically qualifies. And this is also where a lot of confusion and even disappointment can creep in. When governments announce tax breaks or benefits, people often assume it's universal. But the truth is, these programs are almost always tied to eligibility rules. The 2025 senior tax break is no different. To really understand how it works, let's go through the key qualifications step by step. Age requirements, seniors, only the very first rule is simple. This benefit is meant for seniors. In most cases, that means you need to be at least 65 years old by the end of the tax year. If you're 64, even if you're just a few months away from your 65th birthday, you won't qualify for the 6,000 deduction on your 2025 return. There's also an exception for those who are permanently disabled. Some individuals under 65 may still qualify if they meet disability criteria, but generally, for the majority of taxpayers, age 65 is the magic number. Filing status matters. Your filing status has a direct impact on whether or not you qualify and how much of the benefit you can use. Here's how it usually breaks down single filers over 65 eligible for the full 6,000 benefit. Married filing jointly, both over 65, both spouses can claim the benefit, which means double the deductions, potentially 12,000 total. Married filing jointly, one spouse under 65, only the spouse who is 65 or older gets the deduction. Married filing separately, this is where things can get complicated. In some cases, filing separately can reduce the benefit. So seniors in this situation need to weigh their options carefully. Income thresholds. Who actually feels the impact? Here's where a lot of people misunderstand tax breaks. Just because you qualify doesn't mean the benefit will dramatically change your financial picture. The impact depends on your taxable income. For example, if you have very little taxable income to begin with, say your Social Security benefits are your only income, you might not owe federal income taxes anyway. In that case, the 6,000 break doesn't give you any additional advantage. If you have moderate income from retirement accounts, pensions, or part-time work, the deduction could save you a few $100s. If you have higher taxable income, the deduction could save you much more, especially if you're in a higher tax bracket. In short, this benefit is most valuable for seniors who still owe some taxes. If you're already in the zero tax zone, you don't feel the difference. Residency and filing rules. This tax break is a federal level benefit, which means it applies nationwide. But here's the catch. States have their own tax system. Some states don't tax retirement income at all, while others do. That means the 6,000 deduction could lower your federal tax bill but won't necessarily affect your state taxes. Who doesn't qualify? It's equally important to spell out who doesn't qualify, the 48, because a lot of people may hear the headlines and think they're included when they're not. Anyone under 65 without disability status, no matter how close you are to retirement, if you don't hit that age threshold, you miss out. Seniors with little to no taxable income, you technically qualify, but you won't see savings because you weren't paying taxes in the first place. Dependents over 65, if you're claimed as a dependent on someone else's tax return, you may not be able to claim the full deduction yourself. 8, those who fail to file properly. Yes, believe it or not, some people will qualify but won't claim it because they don't fill out their return correctly. That's essentially leaving money on the table. Why this matters, understanding who qualifies and who doesn't is more than just paperwork. It's about managing expectations. Seniors on fixed incomes often pin their hopes on announcements like these, only to be disappointed if they don't actually meet the criteria. That can lead to frustration and financial stress. On the flip side, those who do qualify but don't understand the rules might miss out entirely. For example, a married couple filing separately could lose thousands in potential deductions just because they didn't realize filing jointly would give them more. The bottom line, the $6,000 senior tax break is a real benefit, but it's not for everyone. To qualify, you generally need to be 65 or older, file your taxes correctly, and have enough taxable income for the deduction to make a difference. If you don't tick all those boxes, you may not see any benefit at all. So here's the takeaway. Don't assume. Check the rules carefully, run the numbers for your specific situation, and make sure you file in a way that maximizes the deduction. Because while the headlines make it sound like every senior is getting $6,000, the truth is far more nuanced. And the seniors who take the time to understand the fine print are the ones who actually come out ahead. How to maximize the savings. So you've figured out that you qualify for the 2025 senior tax break. That's fantastic. But here's the real question. How do you get the most out of it? Because a tax break on its own is just a tool. If you don't use it strategically, you're leaving money on the table. The goal here is not just to save a few dollars, but to turn those savings into something that genuinely strengthens your financial future. Let's break down the smartest ways to maximize this new $6,000 benefit. File the right way. Don't miss what's yours. The first step in maximizing this break is obvious, but you'd be surprised how many people miss it. You need to file your taxes correctly. The IRS doesn't automatically hand out deductions. If you don't claim it, you won't get it. That means making sure you or your tax preparer understands the updated 2025 rules for seniors filing jointly. This could mean double the benefit, up to $112,000. But if you accidentally file incorrectly, say by choosing married filing separately, you could slash your potential savings. Use the savings to reduce high interest debt. Here's one of the smartest moves you can make with any tax savings. Pay off debt that's dragging you down. If you're carrying a balance on credit cards or personal loans with interest rates of 15%, 20%, that's money being siphoned away from you every month. Let's say the tax break saves you $800. If you throw that money at a credit card balance, you're not just reducing the principal, you're cutting off future interest payments. Over time, that $800 could save you thousands. That's a much bigger win than just treating it like extra cash. Reinvest the savings for growth for seniors who don't have high interest debt. The next best move is reinvestment. Too many people think investing stops when you retire, but that couldn't be further from the truth. 8, your money should keep working for you even if you've stopped working yourself. You could put your savings into dividend-paying stocks, which can provide a steady stream of passive income. Low-cost index funds or ETFs to benefit from long-term market growth. Bonds or CDs for safer, more predictable returns. Even a few $100s invested each year compounds over time. It's not about striking it rich overnight. It's about creating a growing safety net that keeps giving back. Strengthen your emergency fund. Life has a funny way of throwing curveballs, medical bills, car repairs, home maintenance. An emergency fund is what keeps those unexpected expenses from derailing your retirement plan. If your emergency fund is less than 3 to 6 months worth of expenses, consider using your tax savings to top it up. That way, when life happens, You don't have to dip into your retirement accounts or rack up debt. Peace of mind is just as valuable as financial growth. Plan your withdrawals more strategically. One overlooked way to maximize this benefit is to look at how it interacts with your retirement account withdrawals. Many seniors are required to take RMDs, required minimum distributions, from their 401ks or IRAs. The extra deduction from this tax break can offset some of the tax burden from those withdrawals. For example, if you know your RMD will push you into a higher tax bracket, this 6,000 deduction can help lower the impact. But it only works if you plan ahead. Coordinating withdrawals with deductions can make your money stretch much further. Pair it with other credits and deductions. Here's where smart seniors really win, by stacking this tax break with other credits and deductions. For instance, there are credits for medical expenses, energy, efficient home improvements, or even caregiving situations. When you combine the 6,000 benefit with other strategies, the total savings can be substantial. It's like finding hidden pockets of cash in your tax return that most people never bother to look for. Avoid the spend it all trap. This is where many people slip up. They see the tax savings as free money and immediately spend it on luxuries. Now, there's nothing wrong with enjoying life. That's what retirement is for. But if you want to maximize this benefit, you need to treat it as a building block, not pocket change. The best approach, allocate it wisely. Maybe 70% goes to smart financial moves like debt, savings, or investments, and 30% goes toward enjoying something you've been putting off. That way, you're still making progress without feeling deprived. The bottom line, the 60,000 senior tax break is more than just a line on a tax form. It's an opportunity. The seniors who maximize it won't just use it to cover bills. They'll treat it as leverage, a tool to reduce debt, grow investments, strengthen safety nets, and stretch their retirement income further. The difference between wasting this benefit and maximizing it, it could mean thousands of dollars over the next few years. And that's why understanding how to use it is just as important as qualifying for it in the first place. The bigger picture for retirement planning. Now, here's where most people miss the forest for the trees. Yes, the 6,000 senior tax break is a big deal. It puts extra cash in your pocket, and who doesn't want that? But if all you do is look at this benefit in isolation, you're not really seeing how it fits into the bigger picture of retirement planning. And the truth is, retirement is not about one break, one credit, or 1 year savings. It's about creating a long-term strategy that makes your money work for you until your very last day. Retirement isn't just about getting by. A lot of seniors think retirement planning is simply making sure they don't run out of money.
That's part of it.
Of course, but if that's your only goal, you'll likely live your golden years stressed about every bill, every market dip, and every unexpected expense. The bigger picture is about living comfortably and confidently. It's about having enough breathing room to enjoy your life, whether that means traveling, spoiling your grandkids, or just not lying awake at night worrying about whether you can afford next month's groceries. Taxes don't end when you retire. Here's a hard truth many seniors don't realize until it's too late. Retiring doesn't mean you stop paying taxes. In fact, some people end up paying more because they don't plan properly. Withdrawals from retirement accounts, Social Security income, and even part-time work can all trigger taxes. The new 6,000 benefit is one piece of the puzzle, but the bigger lesson is this: you need a strategy to manage your taxes throughout retirement. That could mean timing your withdrawals so you stay in lower brackets. Using Roth accounts where withdrawals are tax-free. Taking advantage of deductions like this new one to offset income. 8, think of it this way: every dollar you save on taxes is a dollar that stays in your pocket. Over a decade or two, that can add up to tens of thousands of dollars, building multiple income streams. The people who thrive in retirement aren't the ones relying on a single source of income. If all your eggs are in one basket, Say, social security, you're at the mercy of government changes. If all your eggs are in your 401k, you're at the mercy of the stock market. The bigger picture is diversification. Your retirement should ideally have social security as a base. Retirement accounts like 401k IRAs or Roth IRAs, maybe some dividend stocks, bonds or rental income, even side hustles or small businesses if you enjoy them. This tax break gives you breathing room, but you can amplify its effect by reinvesting savings into these other streams. That way, 8, you're not just saving money, you're building resilience. Inflation is the silent enemy. Here's something every retiree needs to remember. Inflation will eat away at your money year after year. A $6,000 tax break might feel huge today, but in 10 years, it won't stretch nearly as far if your overall plan doesn't account for rising costs. The bigger picture is making sure your money grows enough to outpace inflation. That means you can't just stash everything in a savings account earning 1%. You need at least part of your portfolio working in assets that historically outpace inflation, like stocks or real estate. So yes, take the 6,000 no's and break, but also ask, how am I preparing for the fact that healthcare, housing, and food will all be significantly more expensive in 10, 20 years. Planning beyond your lifetime retirement planning isn't just about you, it's about the legacy you leave. Maybe that means making sure your spouse is financially secure if something happens to you. Maybe it means leaving an inheritance for your children or even donating to causes you care about. The bigger picture includes estate planning, wills, trusts, and beneficiary designations. Tax breaks today can be paired with smart estate strategies tomorrow to minimize the burden on your loved ones. After all, you worked hard for your money. You should decide where it goes. 8, not the government. Protecting your health and wealth together. Another part of the bigger picture that people often ignore is healthcare. One major medical event can wipe out years of careful planning. That's why Medicare planning, long-term care insurance, and health savings accounts are just as important as tax breaks. The $6,000 benefit might help cover some out-of-pocket medical expenses, but the real security comes from planning for the big, unexpected costs. Because if your health fails, your finances can crumble right along with it. Your mindset matters most. Finally, the bigger picture isn't just numbers on a spreadsheet, it's about how you think about money. Too many seniors approach retirement with a scarcity mindset, worrying constantly about every dollar. Others go the opposite way and spend recklessly, assuming they'll figure it out later. The sweet spot is balance, being intentional with your money while still enjoying the life you worked for. This tax break is a tool. Use it wisely. But don't let it distract you from the ultimate goal. Financial freedom paired with peace of mind. The bottom line, the $6,000 senior tax break is valuable, but it's just one piece of a much bigger puzzle. Retirement planning isn't about quick wins. It's about creating a strategy that weaves together tax management, income diversification, inflation protection, healthcare planning, and even legacy building. When you see this benefit in that context, it stops being just a little extra money and becomes a powerful lever in your long-term financial game plan. The seniors who succeed are the ones who step back, see the bigger picture, and make every piece work together. Because at the end of the day, retirement isn't about money. It's about freedom, security, and living the life you've earned.